Hello everyone, welcome to the 74th episode of me learning how to trade in Forex. So in the last video we went through how to trade using Heikin ashi. We learned about the five ways of using the Heikin ashi charts in your trading. So the green candlesticks signal an uptrend, green candlesticks with no lower shadow or wick indicate a strong uptrend. Candlesticks with small bodies showing upper and lower shadows indicate a possible trend reversal or trend pause. Red candlesticks signal a downtrend, and red candlesticks with no upper wick indicate a strong downtrend. And now we are on limitations of Heikin ashi. So let's get started. Limitations of Heikin ashi. Date is the 14th. What are the limitations of Heikin ashi? Unfortunately, Heikin ashi is not the holy grail. Heikin ashi definitely ain't no Ed Sheeran song. It ain't perfect. Just like any other tool used for technical analysis, Heikin ashi is useful, but it does have some weaknesses or limitations. Let's go over what these limitations are. Heikin ashi candlesticks do not show true prices. Ashi candlesticks do not show true prices. Whilst the traditional Japanese candlesticks are derived from actual prices, Heikin ashi candlesticks are not. Because the Heikin ashi candlesticks are averaged, they do not show the exact open and close price for a particular time periods, as they are averaged. So they do not show the exact open and close prices for a particular time period. Let's show an actual example. Here's a Heikin ashi chart or Euro USD on the daily time frame. So we've got the up, down, up, down, up. Open price 1.09005, close price 1.08531. Focus on the last candlestick. A couple of things to notice. The candle is red, which means the candle closed lower than it opened. Its open price was 1.09005. Its close price is 1.08531. Now let's take a look at the daily chart of Euro USD using a traditional Japanese candlestick chart. Focus on the last candlestick. A couple of things to notice. The candle is green, which means the candle closed higher than it opened. This is reality. The Euro USD pair actually ended up for the day. Compare this to the Heikin ashi where it showed a red candle. Its open price was 1.08373. So the Heikin ashi said 1.09005. Its close price was 1.08706. And for the Heikin ashi it says 1.08531. So the Heikin ashi's opening price was higher than the reality opening price, and the Heikin ashi's closing price was lower than the reality's closing price. Let's review what we just observed. So chart Heikin ashi, last candlestick is red, traditional shows is green. Open price 1.09005 for the Heikin ashi, and the opening price for traditional was 1.08373. For the close price of the Heikin, 1.08531. For the closing price of the traditional, 1.08706. Do you see the difference? Even though the real candle closed green, Heikin ashi signaling that Euro USD is still in a downtrend. Make sure you know what price you're looking at. Since you can't see the actual open and close prices, some traders prefer to use a Heikin ashi chart as more of an indicator rather than the price chart itself. Make sure you know what price you're looking at. heikin ashi could be used as an indicator rather than a price chart, since it doesn't show true prices. True opening and closing prices. Heikin ashi charts obscure actual price information. This limitation is related to the first one. So heikin ashi charts obscure actual price information. This limitation is related to the first one. The closing price is considered important for many traders, but the actual closing price is not displayed on a heikin ashi candlestick. Right. The actual closing price is not shown on the heikin ashi candlesticks. As a review, here's how the close price is calculated. The close price is open plus high plus low plus close divided by 4. You only see the averaged closing price. Make sure you're aware of the actual closing price and not just the averaged value. Actual closing price not shown on a. Instead, it's the averaged closing price. This can be done easily by switching back to regular Japanese candlestick charts. Heikin ashi charts may not be responsive enough for day traders or scalpers. Since heikin ashi candlestick requires price information from 2 periods, a trade setup takes longer to develop. Heikin ashi charts may not be responsive enough for day traders and scalpers. Since heikin ashi candlesticks requires price information from 2 periods, a trade setup takes longer to develop. A trade setup takes longer to develop since heikin ashi takes price information from 2 periods. This isn't really an issue for long-term traders like swing traders or position traders who have more time to let their trades develop, but it might be an issue for shorter-term traders like day traders and scalpers. For example, scalpers need to exploit quick price moves, so they may find that heikin ashi charts are not responsive enough for their type of trading. Heikin ashi cheat sheet. Ashi cheat sheet. Heikin ashi is a type of price chart that consists of candlesticks, modified Japanese candlesticks. A heikin ashi chart filters market noise and provides a clear visual representation of the trends. Heikin ashi charts filters market noise and provides a clear visual representation of the trend. For beginner traders, this means that the trend is easier to see. For experienced traders, the heikin ashi charts help keep them in trending trades, while still being able to see classical chart pattern setups. Heikin ashi candlesticks look similar to traditional Japanese candlesticks, but they are different, so don't confuse the two. Heikin ashi is different from traditional Japanese candlestick charts in that it takes the prior session open and close into account for the open, which removes any gaps between candlesticks or bars on the chart. Heikin ashi charts takes the prior session open and close for the new open, right? For the new open, which removes any gaps between candlesticks. Hence why it flows so smoothly. How to calculate heikin ashi candlestick? I'm not going to write this down because I've done it before. So the open is a previous candle, open plus close divided by 2. The high, which is the current candle, the highest point, low, which is the lowest point, and the closing price is open plus high plus low plus close divided by 4. How to interpret heikin ashi candlesticks? Green candlesticks are long bodies, uptrend. Red candlesticks, actually, let's do this. Candlesticks with long bodies, signals uptrend. Red candles with long bodies, signals downtrend. Small body surrounded by upper and lower shadows. Small body surrounded by upper and lower shadows. Signals trend, pause, or reversal. Green candlestick with no lower. Green candles with no lower wick. Signal strong, uptrend. Red candles with no lower wick. Signal strong, downtrend. Advantages of heikin ashi are the opportunity to flex. Telling your friends that use heikin ashi chart sounds pretty cool. When compared to the traditional Japanese candlestick charts, heikin ashi slows down the speed of the market, eliminating unnecessary false signals. Whoa. Advantages. Slows down the speed of the market, which eliminates any noise. Oh, unnecessary, which eliminates unnecessary false signals. False signals and retracements are minimized, giving you greater confidence in price action analysis. The visual representation of a strong trend allows you to stay in a trade without having to question yourself or make any knee-jerk reactions. Disadvantages. Any indicator that is based on slowing down the signals is pretty much only useful when price is trending. In a sideways or choppy market, heikin ashi will kick yo ashi. So any indicator that is based on slowing down the signals is pretty much only useful when the price is trending. Disadvantages, so only useful when the price is trending. Since heikin ashi smoothes the price, it can be prone to being late to identify trend reversals. prone to being late in identifying trend reversals. Smooth is the price. Smooth is the price. It can be prone to being late in identifying trend reversals. Which means if you're in a trade, you'll end up with a late signal to close it and giving up some unrealized profits. Heikin Ashi isn't ideal for very short term trading and scalping. Heikin Ashi isn't ideal for short term trading and scalping. Okay, that makes sense. Well, that's the end of the heikin Ashi stuff. Okay. So, introduction to Elliott wave theory. Okay, this is the thing we haven't done yet. Something new. Elliott wave theory. 2024. Elliott wave is a form of technical analysis that was developed by a dude who noticed that financial markets move in repetitive patterns due to underlying crowd psychology based on greed and fear. Back in the old school days of the 1920s to 30s, there was this mad genius and professional accountant named Ralph Nelson Elliott. Where Elliott wave is a form, Elliott wave is a form of technical analysis. By analyzing closely 75 years worth of stock data, Elliott discovered that stock markets thought to behave in a somewhat chaotic manner actually didn't. When he hit 66 years old, he finally gathered enough evidence and confidence to share his discovery with the world. He published his theory in the book entitled The Wave Principle. What is Elliott wave? According to him, the market traded in repetitive cycles, which he pointed out were the emotions of investors caused by outside influences, CNBC, Bloomberg, WSB, or the predominant psychology of the masses at the time. Elliott explained that the upward and downward swings in price caused by collective psychology always showed up in the same repetitive patterns. So the market traded in repetitive cycles. Market traded in repetitive cycles. Always shows in the same. Alright, okay, so market traded in repetitive cycles, which were the emotions of investors caused by outside influence or the predominant psychology of the masses at the time, or the predominant psychology of the masses at the time. Elliott explained that the upward and downward swings in price caused by collective psychology always showed up in the same repetitive patterns. So upwards and downwards swings in price caused by collective psychology always showed up in the same repetitive patterns. Showed up in the same repetitive patterns. He called these upward and downward swings waves. He believes that if you can correctly identify the repeating patterns in prices, you can predict where price will go or not go next. This is what makes Elliott waves so appealing to traders. If you can correctly identify the repeating patterns in price, you can predict where the price. It gives them the way to identify precise points where the price is most likely to reverse. In some other words, Elliott came up with a system that enables traders to catch tops and bottoms. So amidst all the chaos in the prices, Elliott found order. Awesome, huh? Of course, like all mad geniuses, he needed to claim this observation, and so he came up with a super original name, the Elliott wave theory. But before we delve into the Elliott waves, you need to first understand what fractals are. Fractals. What are fractals? Basically, fractals are structures that can split into parts, each of which is a very similar copy of the whole. Oh, well, that's very hypnotizing. Mathematicians like to call this property self-similarity. You don't need to go far to find examples of fractals. They can be found all over nature. Can be split into parts, each of which is a very similar copy of the whole. A seashell is a fractal, a snowflake is a fractal, a cloud is a fractal, heck, a lightning bolt is a fractal. So why are fractals important? One important quality of Elliott waves is that they are fractals. Much like seashells and snowflakes, Elliott waves could be further subdivided into smaller Elliott waves. Ready to be an Elliottician now? Read on. Right. Elliott waves could be further subdivided into smaller Elliott waves. Self-similarity, right? Impulse waves. Mr. Elliott showed that a trending market moves in what he calls a 5-3 wave pattern. Trending market moves in a 5-3 wave pattern. The first 5 wave pattern is called impulse waves. First 5 waves are called impulse waves. Last 3 waves are called corrective waves. In this pattern, waves 1, 3 and 5 are motive. 1, 3 and 5 are motive, meaning they go along with the overall trend, while waves 2 and 4 are corrective. Waves 2 and 4 are corrective, meaning they go along with the overall trend. Do not confuse waves 2 and 4 with the ABC corrective pattern discussed in the next lesson though. Let's take a look at the 5 wave impulse pattern. It's easier if you see it as a picture. Well, that means This still looks kind of confusing. Let's splash some color onto this bad boy. Right, okay, so should have got that instead. Ah, magnifico. It's so pretty. We like colors, so we've color coded each wave along its wave count. Here's a short description of what happens during each wave. We're going to use stocks for our example, since stocks are what Mr. Elliott used, but it really doesn't matter what it is. It can easily be currencies, bonds, gold, oil, or tickle me Elmo dolls. The important thing is that Elliott wave theory can also be applied to the foreign exchange market. Wave 1. The formation of wave 1 indicates that the previous trend has ended and a new trend has emerged. Wave 1. Formation indicates the previous trend has ended and a new trend has emerged. If the previous trend was bearish, then it will now point upwards, and if the previous trend is bullish, then it will now point downwards. So the opposite of whatever the previous trend was. It will point the opposite of the previous trend. Previous trend was bearish, it will now point upwards. If the previous trend was bullish, it will now point downwards. This is usually caused by a relatively small number of people that all of a sudden, for a variety of reasons, real or imagined, feel that the price of the stock is cheap, so it's perfect time to buy. This causes the price to rise. This is usually caused by a relative small number of people that all of a sudden for a variety of reasons, real or imagined, feel the price of the stock is cheap, so it's a perfect time to buy. This causes the price to rise, causing the price to rise. Initially, it can be hard to identify this wave because if the previous trend was bearish, market sentiment will still be negative. Actually, it can be hard to identify this wave because if the previous trend was bearish, aka going down, market sentiment will still be negative. Wave 2. Wave 2 is the first pullback from wave 1 in the direction of the previous trend. At this point, enough people who were in the original wave consider the stock overvalued and take profits. So, first pull back from wave 1 in the direction of the original trend, or the previous trend. At this point, enough people who were in the original wave considered the stock overvalued and take profits, so they sold it. So the original people who bought it, who made the price go up when they bought it, now sold it, right? Enough people who were in the original wave consider the stock overvalued and take profit. This causes the stock to go down. However, the price would not make it to its previous low before the stock is considered a bargain again. As a rule, wave 2 can never retrace more than the entire height of wave 1. So it can't go below wave 1 if wave 1 was going upwards. So wave 2 can't be going down here. And if wave 1 was a downwards, then wave 2 can't go more above where wave 1 is, if you see what I mean, if that makes sense. So this causes the stock to go down. However, the price will not make it to its previous lows. Will not make it to its previous lows before the stock is considered a bargain again. As a rule, wave 2 can never retrace more than the entire height of wave 1. As a rule, wave 2 can never retrace more than the entire height of wave 1. Wave 3. So if it does retrace more, then this Elliott wave thing doesn't apply to the trend, I guess, maybe. Okay, wave 3. Wave 3 is usually the longest and strongest wave, so the biggest one. Usually the strongest and longest wave. The asset has caught the attention of the mass public. So, asset has caught the attention of the mass public. During wave 3 is when the most market participants will realize that the previous trend is over and will now follow the new trend. So during wave 3 is when the most market participants will realize that the previous trend is over and will now follow the new trend. More people find out about the stock and want to buy it. Find out about the stock and want to buy it. This causes the price to go higher and higher because there's going to be less Supply and more demand. Causes the price to go higher and higher. This wave usually exceeds the high created at the end of wave 1. This wave usually exceeds the high created at the end of wave 1. So it would usually be higher than whatever this level is. So if it was here, then the Elliott wave theory doesn't, I want to say maybe or doesn't apply. So it has to be, so pretend there's a flat line here, wave 3 has to be above that flat line. I think that's what it means. In a bullish market, the price during wave 3 rises rapidly. In a bearish market, the opposite occurs. So in a bullish market, the price during wave 3 rises rapidly. In a bearish market, the prices during wave 3 drops rapidly. Wave 4. Wave 4 is corrective in nature and signals that the best part of the trend move is over. Corrective in nature and signals that the best part of the trend, I think, which is wave 3, that the best part of the trend move is over. Traders take profits because the asset is considered expensive again. Traders take profits because the asset is considered expensive again. Wave 4 is difficult to count and may take a long time to develop. Wave 4 is, what does it mean by difficult to count? And may take a long time to develop, but generally should not be longer than the previous wave 3. But generally shouldn't be longer than wave 3. It may take a long time to develop, so that's that, but generally shouldn't be longer than wave 3, so it shouldn't drop all the way like over here. This wave tends to be weak because there are usually more people that are still bullish on the stock and are waiting to buy on the dips. This wave tends to be weak because there are usually more people that are bullish on the stock and are waiting to buy on the dips. Wave 5. Wave 5 is the last move in the direction of the trend. The last move in the direction of the trend. This is the point that most people pay attention to the asset and is mostly driven by hysteria. The point most people pay attention to the asset and is mostly driven by hysteria. Traders and investors start coming up with ridiculous reasons to buy the asset and try to choke you when you disagree with them. This wave marks the last burst of buying before a new trend starts. Traders and investors start coming up with ridiculous reasons to buy the asset and try to, not going to write that down. This wave marks the last bursts of buying before a new trend starts. Eventually, after all, buyers are exhausted and the price loses momentum. Eventually, buyers are exhausted and the price loses momentum. This is when the asset becomes the most overpriced. This is when the asset becomes the most overpriced. Contrarians start shorting the asset, which starts the ABC pattern. Contrarians start shorting the asset, which starts the ABC pattern, which I think we're going to learn about later on. And I think contrarians means people who does the opposite of what what's considered normal to do. So whatever everyone else is doing, they do the opposite. Extended impulse waves. Oh wait. Oh, is that the 5 stages, I guess, all the 5 waves. Yep. First 5 waves, last 3 waves are the corrective. First 5 waves, last 3 waves, right. One thing you should also need to know about the Elliott wave theory is that one of the 3 impulse waves, 1, 3 or 5, 1, 3 and 5, so the one that goes along the trend will always be extended. One of the impulse waves, 1, 3 or 5, will always be extended, so their length will be longer than the other 2. Simply put, there will always be one wave that is longer than the other 2, regardless of degree. Always be one wave that is longer than the other 2. Be one wave that is longer than the other 2, regardless of degree. Regardless of degree. So regardless of how longer that is going to be. So it could just be a little bit longer, but it's still going to be longer. According to Elliott, it is usually the 5th wave that is extended. So the last one. So this one here. According to Elliott, it's usually the 5th wave that is extended. As time went by, this old school style of wave labeling changed because more and more people start labeling the 3rd wave as the extended one. However, more and more people started labeling the 3rd wave as the extended one. Interesting. Okay. Okay. Um, yeah, so I think when we do actually get onto looking at like previous charts and stuff, it would be interesting to see where it would show like this Elliott wave theory stuff. So well, we're trying to see. I remember there's a so 2 and 4 are corrective. Yeah, no, not this chart. Nah, some other charts, I think. Not this one though. So I'm going to leave this episode here. In the next video, we're gonna carry on with the Elliott wave stuff into the corrective waves section. So yeah, thank you guys all for watching, and I will see you then. Peace.